The current live price for Keel Infrastructure Corp, trading under the ticker KEEL on the Toronto Stock Exchange, is CA $3.96 as of 4 p.m. EDT on April 17, 2026, marking a significant intraday climb of 5.88% from its previous close. While many retail traders are looking at this move as a simple technical bounce, the reality under the surface is far more complex. Most of the market is currently viewing Keel Infrastructure through the lens of its past life as a crypto miner, but what they are missing is the massive institutional shift toward its new identity as a pure-play AI data center and energy infrastructure provider. While the average user on a Robinhood app might be tracking the daily swings of Tesla stock or Nvidia stock, the sophisticated money is looking at the 2.2 gigawatt power pipeline that Keel has secured. This is the expectation versus reality gap that is currently defining the price action. The market expects a high beta proxy for digital assets, but the reality is a foundational energy play that is becoming increasingly attractive to Fidelity Wealth Management and those seeking investment help for long-term infrastructure stability. Over the last few trading sessions, the volume for Keel has surged significantly, with over 4.4 million shares changing hands in a single day. This isn't just retail excitement, we are seeing a shift in the type of buyer entering the name. When a company re-domiciles to the United States and rebrands with a focus on high-performance computing, it clears the path for inclusion in different types of Fidelity ETFs and institutional indices that previously wouldn't touch a Canadian-domiciled mining firm. This institutional activity is a massive catalyst because it creates a floor for the stock that wasn't there 6 months ago. If you look at the trading data on an interactive broker's platform, you'll see that the bid-ask spreads are tightening even as the volatility remains high, suggesting that liquidity is improving as more professional desks take positions. The move from CA $3.74 to CA $3.96 in a single session, hitting a 52-week high of CA $4.08 earlier in the day, shows that there is a fear of missing out starting to permeate the professional side of the aisle, not just the Robinhood investments crowd. Despite this upward momentum, there is a contrarian view worth considering. The bears argue that Keel is simply slapping a new AI label on old hardware, but the filing of their recent shelf registration tells a different story. By securing the ability to issue up to 1.5 billion shares of common stock, the company is preparing for massive capital expenditures. To the untrained eye, this looks like impending dilution, which usually sends a stock lower. However, in the infrastructure world, capital is the fuel for growth. When you are competing for grid interconnections in Pennsylvania and Washington, you need a war chest. The smart money using Fidelity Investments or SoFi Active Investing understands that this dilution is actually the precursor to securing more megawatts. This is where the tension lies. The market narrative says dilution is bad, but the infrastructure reality says capital is king. If you are looking at this through a SoFi trading platform or managing your own individual brokerage account, you have to ask yourself why the stock is outperforming the TSX 300 by over 130% on a one-year basis. It's because Keel has successfully transitioned its business model. They are no longer just chasing the price of a single digital asset. They are building the hotels where AI compute lives. This business model is built on long-term power contracts and physical real estate. Think about the way Apple stock isn't just about selling a phone anymore, but about the ecosystem and the services. Keel is trying to build the physical ecosystem that the entire AI industry relies on. They are positioning themselves as the keel of the ship, the foundational part that keeps everything else upright. This is a much more stable and predictable revenue model than what they had before, which is why analysts now have a consensus target price of CA $5.24, representing nearly a 40% upside from current levels. Let's look at the actual operations for a moment. Keel Infrastructure Corp, formerly known as Bitfarms, is headquartered in New York City and operates a massive pipeline of energy-secured sites. They have 648 megawatts of secured capacity and another 1.5 gigawatts in the planning stages. For those using online investing tools or investment platforms like Fidelity Brokerage, it is essential to understand that in the current market, power is the most valuable commodity. It doesn't matter how fast an Nvidia chip is if you don't have the electricity to run it. Keel's established grid interconnections with PJM Interconnection LLC give them a massive head start. Building a new data center from scratch can take years just for the permitting and power allocation. Keel already has the dirt and the juice. This is why they are becoming a favorite for those using Schwab Intelligent Portfolios or other online investment strategies that focus on the picks and shovels of the AI boom. Comment below how many shares of Keel Infrastructure you currently hold, or if you are waiting for a pullback before entering. It's interesting to see how many of you are coming over from the crypto side versus those who are strictly looking at this as a data center play. Looking ahead, the catalysts for Keel are numerous, but not without risk. The upcoming Q1 2026 earnings release on May 18th will be the first real look at the new Keel. Investors will be looking for progress on their U.S. expansion and any new contracts for AI high-performance computing. If they can show that they are successfully converting their mining sites into AI-ready data centers, the stock could easily blast through that $5.24 target. However, the risk remains in the execution. Building out 2.2 gigawatts of capacity requires billions of dollars and flawless management. Any delays in utility hookups or construction could sour the current sentiment. Those using Fidelity IRAs or SoFi Invest should keep a close eye on the company's debt-to-equity ratio as they ramp up the spending. For the person using a Fidelity mobile app or Robinhood stock trading to manage a portfolio, the lesson here is about the transition from speculative growth to industrial infrastructure.
Keel is trying to bridge that gap. They are moving from a world of high volatility and low predictability to a world of high capital requirements but massive long-term moats. The fact that they are already trading 11% above their 200-day moving average suggests that the trend is firmly to the upside. The market is starting to price in the reality of their power pipeline, even if the expectation of them being a simple miner still lingers in some corners of the retail market. In the world of self-investing, it's easy to get lost in the daily noise. But if you look at the move Keel has made, redomiciling to Delaware, rebranding, and pivoting to AI, it is clear they are aiming for a much larger pool of capital. They want to be a staple in Fidelity mutual funds and a core holding for Fidelity wealth management clients who need exposure to the energy side of the AI boom. They're competing with the big boys now, and their stock price is starting to reflect that ambition. The volatility we see today, with the price jumping nearly 6% in a single session, is just the market trying to find the fair value for a company that is fundamentally different than it was a year ago. When you use investing sites to research companies like this, you often see a lot of legacy data that doesn't tell the whole story. You might see a negative EPS of negative 0.32 and think the company is struggling. But in the infrastructure world, negative earnings are common during a massive build-out phase. What matters more is the asset value and the replacement cost of their power contracts. If you tried to go out and secure 2 gigawatts of power in the US today, it would cost you a fortune and take a decade. Keel already has the rights. That is the hidden value that is starting to get uncovered by the market. Whether you are using Robinhood crypto to trade the swings or SoFi ETFs for broader exposure, understanding this power-first strategy is the key to understanding Keel's future. To wrap this up, Keel Infrastructure Corp is currently in the middle of a massive identity shift. The expectation was that they would remain a high-risk, high-reward digital asset play. The reality is that they are becoming a foundational energy and infrastructure giant. The live price of CA $3.96 reflects a market that is starting to wake up to this fact, but the gap between its current valuation and its 2.2 gigawatt potential remains wide. As they move closer to their May earnings and continue their US expansion, expect the tension between their old reputation and their new reality to continue driving significant price action. For the disciplined investor using a Fidelity trading platform or Interactive Brokers trading, this is a name that demands attention, not for what it was, but for the critical role it is positioned to play in the future of global compute. The market has moved, the company has moved, and now the price is following. Keep a close eye on the volume. As long as it stays high, the institutional transition is still in full swing. This isn't just a stock to watch, it's a case study in how a company can completely change its keel to stay upright in a changing economic sea. By focusing on the foundational power needs of the AI industry, Keel has found a way to make itself indispensable, and that is the most authoritative position a company can hold in today's market. Stay grounded in the data, watch the capital expenditures, and remember that in the world of infrastructure, the one who owns the power usually wins the game. This shift from speculative to foundation is the defining story for Keel in 2026, and the price action is just the first chapter. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.